For many, a bank account represents security, the safe harbor for hard-earned savings. But what if that trust is shattered? What really happens when the institution holding your money, your bank, suddenly collapses? It's a scenario that seems impossible in our modern financial system, yet it has happened repeatedly throughout history, shaking public confidence and livelihoods. Today, we'll peel back the layers to understand the mechanisms at play when a bank fails, and how your money is, or isn't, protected. A bank doesn't just vanish overnight. Its failure is typically a culmination of various factors: poor management, risky investments, or a sudden, severe economic downturn. Banks operate by taking deposits and lending that money out, expecting a healthy return. When loans sour, or investments lose significant value, the bank's assets can no longer cover its liabilities, the deposits it owes to its customers. This imbalance creates a solvency crisis, leading to the regulatory decision that the bank is effectively, and legally, insolvent. Before the modern safety nets, bank failures were catastrophic and common. The Great Depression witnessed a staggering loss of public trust as thousands of banks crumbled, wiping out life savings and exacerbating the economic crisis. Between 1929 and 1933, over 9,000 U.S. banks failed, creating widespread panic and a vicious cycle of withdrawals. People literally lost everything, demonstrating the urgent need for a robust system to protect depositors and stabilize the financial sector. In response to this devastating era, the U.S. government established the Federal Deposit Insurance Corporation, or FDIC, in 1933. Its mission was clear: restore confidence in the banking system. The FDIC introduced a revolutionary concept: deposit insurance, guaranteeing that a depositor's money would be safe, even if their bank went under. This fundamental shift transformed how Americans interacted with their banks, ending the era of bank runs driven by sheer panic and uncertainty. It marked a turning point in U.S. financial history. Today, the FDIC remains the cornerstone of U.S. banking stability. It insures deposits up to $250,000 per depositor, per insured bank, for each account ownership category. This means your checking, savings, money market accounts, and certificates of deposit are covered. The key here is per ownership category. For instance, a single account, a joint account, and an IRA at the same bank are each insured separately. This crucial protection ensures that the vast majority of Americans never lose a cent of their insured funds. When a bank fails, the FDIC steps in immediately. Its primary roles are to manage the receivership of the failed institution, meaning it takes control of the bank's assets and liabilities. The agency then works quickly to sell off these assets and resolve customer accounts. For insured depositors, this process is remarkably swift. They typically regain access to their funds, often within days, either through a new bank acquiring the failed one or directly from the FDIC. This rapid intervention minimizes disruption and maintains trust. While the FDIC provides robust protection, it's vital to understand its limits. Funds exceeding the $250,000 insurance limit, per ownership category, are considered uninsured deposits. Customers holding these larger balances become general creditors of the failed bank. This means they are paid back from the proceeds of the bank's asset sales, but only after secured creditors and other priority claims have been satisfied. There's no guarantee they will recover the full amount, and the recovery process can be lengthy, with only partial returns possible. One of the most significant bank failures in U.S. history was that of Washington Mutual, or WAMU, in September 2008, amidst the escalating financial crisis. With $307 billion in assets, it remains the largest bank failure in U.S. history. WAMU's downfall was primarily due to its heavy exposure to risky subprime mortgages, which began defaulting at alarming rates. As the mortgage market collapsed, confidence in WAMU evaporated, leading to massive withdrawals from depositors. Facing a bank run and an imminent collapse, the FDIC stepped in. To minimize disruption and protect all depositors, the FDIC swiftly brokered a deal. On September 25, 2008, JP Morgan Chase acquired most of WAMU's assets and liabilities, including its entire deposit base, for $1.9 billion. This strategic sale meant that both insured and uninsured depositors were fully protected, as their accounts were immediately transferred to a stable institution. The FDIC's quick action prevented widespread panic and contagion. Fast forward to March 2023, and the financial world faced another shockwave with the collapse of Silicon Valley Bank, or SVB. Unlike WAMU, SVB's failure stemmed from a different set of vulnerabilities. It was a niche bank, specializing in tech startups and venture capital firms. During the pandemic, SVB experienced an unprecedented surge in deposits from its rapidly growing tech clientele. This flood of cash presented a unique challenge and, ultimately, a fatal misstep. To manage the influx of deposits, SVB invested heavily in long-term, low-yield U.S. Treasury bonds. This strategy seemed safe at the time, but it proved disastrous. As the Federal Reserve began aggressively raising interest rates to combat inflation, the market value of these existing low-yield bonds plummeted. SVB found itself sitting on billions in unrealized losses. Simultaneously, the tech sector began to slow, leading many of SVB's clients to start withdrawing funds to cover operational costs. The combination of unrealized losses and increased withdrawals created a liquidity crisis for SVB. When news of the bank's financial struggles became public, a full-blown bank run ensued, with clients attempting to withdraw billions in a single day. The FDIC quickly stepped in on March 10, 2023, declaring SVB insolvent. Given SVB's critical role in the tech ecosystem and the systemic risk it posed, the Treasury Secretary, Federal Reserve, and FDIC Board invoked the Systemic Risk Exception, SRE. The systemic risk exception is a powerful tool designed for extraordinary circumstances. It allows the government to protect all depositors, both insured and uninsured, if a bank's failure poses a significant risk to the broader financial system and economic stability. Invoking the SRE requires approval from the Treasury Secretary, the President, and the FDIC Board. It's a rare measure, typically reserved for situations where the ripple effects of a failure could trigger a cascade of instability, impacting countless other banks and businesses. Thanks to the systemic risk exception, all depositors at Silicon Valley Bank, regardless of the size of their balance, were fully protected. This decision was crucial in preventing further panic within the tech sector and beyond. Shortly after, Signature Bank, which also had a significant proportion of uninsured deposits and faced similar liquidity pressures, also failed. The SRE was invoked for Signature Bank as well, ensuring that all its depositors were protected. This swift, decisive action stabilized a volatile situation. While both Washington Mutual and Silicon Valley Bank were significant failures, their resolutions highlight different facets of FDIC intervention. WAMU's collapse, driven by subprime mortgages, was resolved through a direct sale to J.P. Morgan Chase, protecting all depositors without invoking the systemic risk exception. SVB's failure, tied to interest rate risk and a concentrated client base, necessitated the rare use of the SRE. Both outcomes ensured depositor protection, but the paths taken underscore the evolving challenges and tools available to regulators. When a bank fails, the immediate impact on customers can range from minor inconvenience to severe disruption. Insured depositors typically experience swift access to their funds, minimizing financial stress. However, businesses and individuals with uninsured deposits face significant uncertainty. They may lose access to critical operating capital for weeks or months, potentially jeopardizing payrolls, supplier payments, and even the viability of their enterprises. The stress and anxiety during such periods are immense, highlighting the importance of understanding your deposit coverage. The SVB and Signature Bank failures also highlighted a particular vulnerability for regional banks. These institutions often serve specific industries or geographic areas and tend to have a higher proportion of uninsured deposits compared to larger, diversified national banks. This makes them inherently more susceptible to rapid bank runs, as a small group of large depositors can withdraw significant sums very quickly, creating a liquidity crisis that can spiral out of control before regulators can react. It's a key lesson for future oversight. The repercussions of bank failures extend far beyond individual depositors. They can trigger wider economic instability, shaking investor confidence and tightening credit markets. When businesses can't access funds or secure loans, it stifles growth, leads to job losses, and can even tip an economy into recession. Government intervention, whether through FDIC receivership or the systemic risk exception, aims not just to protect depositors but to safeguard the entire financial ecosystem from cascading failures and widespread economic damage. The failures of banks like Washington Mutual and Silicon Valley Bank, separated by over a decade, offer invaluable lessons. They underscore the dynamic nature of financial risks and the constant need for regulatory vigilance. The FDIC's role remains paramount, adapting its strategies and tools to new challenges, from mortgage-backed securities to interest rate volatility. For depositors, the message is clear: understand your insurance limits, diversify your holdings, and stay informed about the health of your financial institutions. Trust is hard-won and easily lost.